Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. And today, we're looking at Archer Aviation.
If you find our talks useful, please consider subscribe, like, and comment underneath. Okay, so let's unpack this. It is Thursday, February 19th, 2026. And we are looking at a company that has, well, it's fascinated me for a long time because it feels like something out of a sci-fi novel.
Flying cars, basically.
Flying cars, Archer Aviation, eVTOLs. For the longest time, this has been what I call a concept stock. You're buying the dream, the glossy brochure, the cool CGI video.
But not really a business.
Exactly, not a real business yet. But looking at the notes today, it seems like that whole narrative is finally shifting.
It is, and that's exactly why we're talking about it today. We are at a very specific, a very critical pivot point.
Okay.
If you've been watching this space for the last few years, you're used to seeing cool renderings, maybe some test flight videos over a desert somewhere.
Sure.
But not a lot of money actually changing hands.
Right.
And that is changing, like right now.
So are we officially moving from cool science project to, real business with a bank account?
That's the argument. And the timing is really key here. Look at where they were just a few months ago. As of the third quarter of 2025, Archer was still technically pre-revenue.
So zero commercial passengers.
Zero ticket sales. If you looked at the income statement, it was basically just a list of expenses.
Right.
But here we are, mid-February 2026, and the guidance suggests they are positioned to recognize their first material revenue streams in this current half of the year.
Wow. That is a huge psychological shift for investors. I mean, going from 0 to 1 is always the hardest step.
Exactly. It completely changes the valuation models. But what's fascinating here is where that money is coming from.
Okay.
I think a lot of people just assume the first dollar Archer makes will be from, say, a tourist buying a ticket to fly from Manhattan to JFK.
Sure, the air taxi model.
But that's not actually the case. They've diversified how they make money before the first passenger ever sits down in a seat.
Right, and that's a crucial distinction. We aren't just waiting for an air taxi service to launch to see cash flow. There are other levers they're pulling. But before we get into those levers, I have to ask the question that keeps every growth investor up at night. The money situation.
The cash burn.
The cash burn. Building these things is incredibly expensive. You're building a new type of airplane from scratch. You have to certify it, test it, build factories. Are they running on fumes?
No, and that's really the fortress part of the thesis here.
Yeah.
If you look at the balance sheet, they're actually sitting on a massive pile of cash.
Okay.
As of the third quarter of 2025. And bolstered by a pretty significant raise they did back in November, about $650 million.
Yeah.
Their total liquidity is over $2 billion.
$2 billion. That is a lot of runway. That's not just keeping the lights on. That's a war chest.
It is. In this industry, cash is oxygen. If you run out of cash before you get certified by the FAA, you die. Or you get bought out for pennies on the dollar by a legacy player. That $2 billion gives them roughly a 2 to 3 year runway. That is enough to get them through the certification process and into initial commercialization without having to go back to Wall Street with a begging bowl.
That puts them in a rare position. A lot of other startups in the space are constantly stressing about payroll.
Definitely.
But they're spending that money on some interesting things. It's not just engineers and carbon fiber. I saw 2 line items here that really surprised me. One involving a defense contractor and one involving buying an entire airport.
This is where the strategy gets really smart. Let's talk about the defense angle first. They have a partnership with Anduril Industries.
Anduril, yeah, a massive name in defense tech. They're the disruptors in that space.
Huge. So Archer announced this partnership late in 2024. It's a technology licensing deal. Essentially, they're helping to fund military aircraft development using Archer's tech.
So it generates cash, but it also does something else, right?
It validates the technology.
Right, because the military doesn't mess around. If the defense sector is interested, it implies robustness. It's not just a toy.
Exactly. It's a stamp of approval from the most demanding customer on the planet. And then you have the airport.
Yes, the airport. Why buy an airport? I mean, usually airlines just pay to land. They don't buy the tarmac.
It's the Hawthorne Airport in Los Angeles. They bought it for about $126 million. Now, on the surface, spending that much when you're burning cash, it seems risky.
A bit of a vanity purchase, maybe.
A skeptic might say that. But it's a strategic moat. Hawthorne isn't just a place to park planes. It serves as a dedicated testing hub right in one of their key launch markets.
Ah, so they don't have to ask permission to run tests. They own the place.
Exactly. But even better, it generates operating cash flow.
Oh, because it's already an operating airport.
Correct. Private jets land there, people buy fuel, there are hangar fees. So Archer now owns an asset that pays them, while also giving them a playground to protect their operations. They control their own destiny on the ground.
That is clever. It turns a cost center testing into a potential profit center.
Okay, so they have the cash, they have the infrastructure. But is this just a U.S. story? Because I feel like the FAA, and we'll get to them in a minute, can be a bottleneck.
A huge bottleneck.
Is Archer putting all their eggs in the American basket?
Not at all. In fact, if you look closely, the international validation is actually moving faster in some ways. And this is a key part of the bull case. It's almost like regulatory arbitrage.
Go where the skies are friendlier.
Or at least where the regulators are faster. Let's start with Europe, specifically Serbia. Serbia selected Archer as the partner for XPO 2027.
XPO 2027. That's a massive global event.
It is. And the deal includes an option to purchase up to 25 of their Midnight aircraft. That is tangible pre-order signal. It's not just, we like your PowerPoint. It's, we want 25 of these for our global showcase.
And I remember reading about the Middle East as well. The UAE seems to be very aggressive with this kind of tech. The Middle East is critical. In fact, the launch agreements there are the primary driver for that revenue recognition we expect in the first half of this year.
So that's the first money coming in.
That's the first money. The regulatory environment in places like the UAE can be more agile than the U.S., allowing them to get birds in the air and money in the bank faster. Plus, they have active partnerships in Japan. This global footprint de-risks the whole business.
It's a portfolio approach to geography. That makes a lot of sense. Now let's touch on the technology itself for a second. There are a lot of companies trying to make eVTOLs. What makes Archer's Midnight aircraft special?
It's the brain of the aircraft. This is where their partnership with NVIDIA comes in.
NVIDIA, the AI kingmakers, everyone wants a piece of them right now.
And we've seen this integration of NVIDIA's AI systems into Archer's flight computers. This isn't just about, keeping the plane stable. It's about the path to autonomous flight. Right now, the plan is to have a pilot. But the economics of this business get exponentially better if you can eventually remove the pilot.
Because you save on the pilot's salary and you free up a seat for a paying passenger.
Exactly. The NVIDIA partnership suggests Archer is building that capability into the tech stack from day one. It differentiates them. They are building a software platform that flies.
That is a massive differentiation. But regardless of how smart the AI is, you still need permission to fly. Let's talk about the elephant in the room, the FAA.
The Federal Aviation Administration. They are the gatekeepers, and they are notoriously slow. Safety is their only metric, not stock price.
So where does Archer stand with them right now?
They are progressing toward what's called Stage 4 certification. There are multiple stages. Stage 4 is a big one. But we have to be realistic here. As of early 2026, only about 15% of the documentation for Stage 4 is complete.
15%, 1.5, that sounds low. I mean, if I told you I was 15% done with my homework, you wouldn't be impressed.
It sounds low, but it's actually significant progress given the complexity. We are talking about thousands of pages of technical data, but this is the bottleneck. This is why that $2 billion runway matters.
Right, they need the cash to wait it out.
It's a waiting game.
So for the listener holding the stock or thinking about buying, what are we waiting for? What is the when-moon moment in the next few months?
We have a very specific catalyst calendar for February through April of this year. The big one is the EIPP.
EIPP, break that down for us.
The Enhanced Innovative Pilot Program. This is a White House and FAA initiative. Essentially, it's the golden ticket for U.S. taxi trials.
Okay.
Being selected for this program means you get a streamlined path to actually testing these things in real-world scenarios. We expect the selections to be announced in early to mid-2026.
So if Archer gets named, that's a massive green light.
Huge. It's a major de-risking event. It tells the market the U.S. government is serious about helping us fly. It validates them as a chosen winner.
And the other catalyst is that revenue we mentioned.
Yes. Turning on the revenue tap from those Middle East deals. We're expecting that in Q1 or Q2. Moving from a company that just loses money to a company that generates revenue, even if it's not profitable yet, changes the algorithm for a lot of big investors.
So the stock moves based on these permissions and first checks, not necessarily mass adoption yet. It's about proving it can happen.
Exactly. It's a de-risking trade. Every time they check a box, EIPP, first revenue, next percentage of certification, the risk premium should drop, and the stock price should theoretically rise.
Speaking of the stock price, let's look at the chart, because if you've been holding this for the last 6 months, you might be feeling a little seasick.
It has been a roller coaster. If you look at the charts, the stock fell about 50% from its peak in October 2025, just a straight drop.
Ouch. That is painful. That's the kind of drop that makes you want to delete your brokerage app.
It is. But, and here's the technical pivot, as of mid-February, it has recovered slightly, up about 2.4%. Now, that doesn't sound like much.
No.
But in technical analysis, that kind of stability after a 50% drop suggests that the weak hands have sold out. We call this capitulation. The people who were panicked are gone.
So the selling pressure has exhausted itself. Who is stepping in to buy?
This is what catches my eye. While retail investors were panic selling, institutional interest actually increased. Specifically, ARK Invest.
Kathy Wood. She loves this kind of stuff.
She does. Her fund has increased its exposure as of January. Now, whatever you think of ARK, they are known for doing deep research on disruptive tech. They're buying signals, smart money conviction for a 5 to 10-year horizon.
And what about the broader Wall Street consensus?
In this case, they have company. There are 7 analysts covering the stock. The average price target is around $12.14.
And where are we trading relative to that?
That target implies a massive 71 to 79% upside from current levels. When you see a consensus upside that high, it usually means the analysts think the market has severely overreacted.
That is a lot of upside. But we have to be responsible here. What kills this thesis? If I buy this today, what goes wrong that wipes me out?
The bear case is real, and it centers on burn rate and execution.
How much are they burning?
It's expensive. For Q4 of 2025 alone, they're projected to lose between $110 and $140 million in adjusted EBITDA. And looking at the full year of 2026, that loss could potentially balloon to $700 million.
$700 million in a year. That is almost $1 billion out the door.
Right. Now remember, they have $2 billion in the bank.
Oh.
So they can afford it for now. But the risk is execution. If that stage 4 certification we talked about drags on.
If it goes past 2027.
Exactly. Suddenly that pre-revenue period extends, and that $2 billion cushion starts to look a lot smaller.
Yeah.
If they have to raise more money because the FAA delayed them, the stock will get crushed.
And that's the volatility risk.
That's it. This stock dropped 18% in 2025 despite long-term gains. It is a high volatility play. If you need this money for a down payment on a house next month, do not put it in Archer Aviation.
So putting it all together, fortress balance sheet, a strategic pivot to revenue, huge international deals, but a very high cash burn and a regulatory gatekeeper that moves at the speed of government. What's the verdict?
If I had to score this, I'd give it a bullish score of 7.5 out of 10.
7.5? That's pretty strong given the risks.
It is. The rationale is the asymmetry. The bad news, the delays, the burn, it's largely priced in with that 50% drop. The good news, the EIPP selection, the Middle East revenue, is not fully priced in yet.
So it's a trade on the upcoming catalysts.
Ideally, this is a 12 to 24-month swing trade. The strategy would be to target entry on dips below $10. You want to be buying when others are nervous.
And the exit.
You target an exit around $15 to $18. That lines up with the higher analyst price targets.
A $10 entry, 15 to 18 exit, that's a solid 50 to 80% potential gain if the thesis plays out.
Right. It offers asymmetric risk-reward for those who can handle the swings.
Yeah.
You have to be able to stomach a 10% drop on a random Tuesday because of a vague headline.
Yeah.
But if you can hold through that, the setup for the next 2 years is very compelling.
It sounds like the flying car future is finally colliding with the reality of a P&L statement. And for once, the math might actually work out. It's going to be a fascinating few months to watch.
Absolutely. The next 90 days are critical. Keep an eye on those EIPT announcements. That's the start.
We certainly will. That brings us to the end of this deep dive into Archer Aviation. I want to thank you for tuning in to Smart Wealth with Joshua. We know your time is valuable, and we appreciate you spending it with us to get smarter about these high-growth names.
And remember, always do your own research. We're connecting the dots, but it's your portfolio.
Until next time.
Goodbye.